You're not as rational about money as you think you are. Nobody is. A landmark research paper published through Harvard's academic network in July 2025, titled Behavioral Biases and Wealth Accumulation, a psychological framework for financial decision-making, found something that should disturb you. Cognitive biases are ubiquitous across income levels, meaning the same mental traps that destroy the finances of low-income households are actively operating in the minds of high-income earners too. The traps don't care how smart you are. They don't care how much you earn. They are systematic. They are predictable, and they're running in your brain right now, costing you money in ways you have never been able to see clearly. Until today. Today I'm going to walk you through 10 of the most documented, most researched, most wealth-destroying mental traps that behavioral economists have identified. For each one, what it is, the real research behind it, the specific financial behavior it produces, and the countermove. Because the research is also clear on this, awareness of a bias is the first and most powerful step toward neutralizing it. You cannot fight what you cannot name. Let's name all 10. Trap number 1, and the most financially destructive bias ever documented, present bias. The Financial Planning Association published a landmark paper in February 2026 defining this precisely. Humans mentally discount future gains in a non-linear manner. A delayed reward is valued far less than one available immediately, even when the future reward is objectively more valuable. The 65-year-old version of you, the one who will either have retirement savings or won't, does not feel real to your brain today. So your brain optimizes for today. Every buy now, pay later purchase, every missed retirement contribution, every I'll start saving next month, is present bias operating exactly as designed. Countermove. Make your future self concrete and automatic. Richard Thaler's Nobel Prize-winning research showed that automatic enrollment in retirement savings eliminates present bias almost entirely because no decision is ever made in the moment. Set up automatic contributions today, then remove the ability to disable them easily. Make future you as hard to betray as possible. Trap number 2, documented by Daniel Kahneman and Amos Tversky in their Nobel Prize-winning prospect theory, loss aversion. The psychological impact of a loss is approximately twice that of an equivalent gain. Losing $100 feels twice as bad as gaining $100 feels good. The financial consequence. Investors hold losing positions far too long, hoping to get back to even, while selling winning positions too early to lock in the gain. This pattern is called the disposition effect, and it has been documented across millions of brokerage accounts. BBH Wealth's research confirmed. People maintain losing investments for too many months despite rationality, urging them to sell. Countermove. Set predetermined exit rules before you invest, not after. Decide in advance. If this position drops 15%, I sell. No emotion, no deliberation. The rule was made when you were calm. Follow it when you're not. Remove loss aversion from the equation by removing the real-time decision. Trap number 3, and the one that costs active traders the most money, overconfidence bias. The SSRN research paper published in 2025 found overconfidence leads to overestimation of knowledge and underestimation of risk. The academic research reinforces this. Overconfidence bias manifests as traders overestimating their ability to predict market movements, leading to excessive trading frequency and underestimation of risk. Dalbar's annual research consistently documents the consequence. The average actively trading investor consistently underperforms the index they are trading, not because markets are irrational, but because the trader is overconfident in their ability to beat them. The research on trading frequency is unambiguous. Frequent traders are more affected by cognitive distortions and achieve poorer long-term performance. Countermove. Own the index. You cannot be overconfident about the performance of every company in the S&P 500 simultaneously. Index fund investing eliminates the overconfidence trap entirely because you are not making predictions. You are owning the outcome. Trap number 4, the one that turns financial echo chambers into financial disasters. Confirmation bias. The behavioral finance research is consistent across multiple papers. Investors actively seek out information that confirms their existing beliefs and ignore contradictory evidence. If you believe a stock will rise, you will unconsciously collect data that supports that belief and dismiss data that contradicts it. The SSRN Harvard paper identifies this as one of the key biases that erodes wealth. Investors influenced by confirmation bias make concentrated, undiversified bets on positions they are already emotionally committed to and hold them far beyond what fundamentals justify. Countermove. Deliberately seek the strongest case against every investment thesis you hold, not to find reasons to sell, but to ensure your belief is surviving contact with contrary evidence. If your thesis cannot survive its strongest opposition, it was never solid. Steelman the opposite view before you commit. Trap number 5, and the one banks deploy against you on every credit card statement. Anchoring bias. The SSRN research identifies anchoring as one of the key biases distorting financial decisions. Humans latch onto the first piece of numerical information they receive and use it as the reference point for all subsequent decisions. When your credit card statement shows a minimum payment of $45 on a $4,500 balance, 45 becomes the anchor. Your brain treats 45 as the normal, reasonable payment. University of Warwick research showed that displaying minimum payment amounts prominently on statements causes people to pay significantly less toward their balance than when only the total is shown. The anchor is not informational. It is a behavioral trap built into the document. Countermove. Remove the anchor by converting every financial figure to annual total cost. The minimum payment isn't $45. It's $540 a year, while interest compounds on the balance. The fee isn't $12 a month. It's $144 a year. Annual dollar totals break anchoring because they make the true cost undeniable. Trap number 6, the one that produced GameStop in 2021, crypto in 2021, and meme stocks in every cycle. Herd mentality. The behavioral finance research published in academic literature is unambiguous. Herding behavior, following what others do rather than individual analysis, leads investors to buy at peaks and sell at bottoms. The SSRN Harvard paper identifies herd behavior as one of the systematic patterns of irrationality that shapes how people invest and accumulate, or fail to accumulate, wealth. J.P. Morgan's own research documented the real cost. Investors who followed the crowd into meme stocks in 2021 took devastating losses when those stocks crashed in subsequent weeks. The crowd was unanimous at the peak, and unanimously wrong. Countermove. Make a rule that you never invest in anything that is currently trending on social media. Not because trending assets can't go up, but because by the time an investment is trending, the crowd is already in, and you are the liquidity the early movers are selling into. Trap number 7. Richard Thaler's Nobel Prize-winning contribution to behavioral economics. Mental accounting. Humans treat money differently based on where it came from or where it is allocated, even though all money is mathematically identical. A tax refund is treated as found money and spent impulsively. A bonus is treated as extra and allocated differently than salary. Money in a vacation fund is never touched, but money in a checking account bleeds freely. This irrational categorization produces measurably worse financial outcomes. The SSRN Harvard research identifies mental accounting as one of the documented biases that shapes saving and investing behavior in systematic, suboptimal ways. Countermove. Treat every dollar identically regardless of source. Tax refund, bonus, regular paycheck, same allocation rules apply. Every dollar gets a job assignment before it can be mentally recategorized. The system eliminates the categorization trap. Trap number 8, the cognitive vulnerability that every financial marketer exploits daily, the framing effect. The IJFMR behavioral finance research confirms how information is framed dramatically changes financial decisions, even when the underlying facts are identical. A fund described as having a 30% chance of loss sounds dangerous. The same fund described as having a 70% chance of gain sounds appealing. Identical product, identical risk profile, completely different emotional response, and completely different investment behavior. Banks use this constantly. Overdraft protection framed as safety rather than a $35 fee every time your balance drops below zero produces dramatically higher opt-in rates. Countermove. Reframe every financial decision yourself before accepting the institution's framing. Convert gains to losses and losses to gains. Restate fees as annual totals. Restate interest rates as dollar costs. The frame that serves you is always the one that makes the true cost most visible. Trap number 9. The bias that costs Americans billions every year in foregone returns. Status quo bias. Samuelson and Zeckhauser documented this in 1988. Humans consistently prefer the current state of affairs, even when changing would produce a clearly superior outcome. The financial consequence is devastating and invisible. Not switching to a high-yield savings account costs the average American hundreds of dollars per year in lost interest. Not updating a 401k allocation from a high-fee fund to a lower-cost index fund can cost tens of thousands over a career. Not refinancing a mortgage when rates drop. Not canceling an unused subscription. Inaction feels safe. But in finance, inaction has a measurable compounding cost. Countermove. Schedule a quarterly financial audit. 1 hour every 3 months. Every account reviewed. Every fee identified. Every rate compared to current alternatives. Status quo bias is defeated not by willpower, but by a scheduled forcing function that produces action on a calendar rather than leaving it to spontaneous motivation. Trap number 10, and the final one, because it synthesizes every market mistake into one. Recency bias. Humans give disproportionate weight to recent events when predicting the future. When a market has risen for 3 years, investors assume it will keep rising and take on excessive risk. When a market has crashed, investors assume the crash will continue and panic sell. Both reactions are documented and predictable. The SSRN Harvard Behavioral Finance paper confirms. Recency bias is one of the systematic patterns of irrationality that shapes how people invest. Dalbar's research shows this as a primary driver of the consistent gap between market returns and actual investor returns. Investors buy after recent gains and sell after recent losses, in perfect inverse timing. Countermove. When making any investment decision, deliberately look at a 20-year chart, not a 20-day chart. Context kills recency bias. The market that looks catastrophic on a 3-month view looks like a minor dip on a 20-year view. And the investment that looks unstoppable on a 3-month view is almost certainly reverting toward its historical mean. Zoom out. Always zoom out. 10 traps. Present bias. Automate your future. Loss aversion. Set exit rules before you invest. Overconfidence. Own the index instead of trading it. Confirmation bias. Steelman the opposite view. Anchoring. Convert everything to annual dollar totals. Herd mentality. Never invest in what's trending on social media. Mental accounting. Treat every dollar identically regardless of source. Framing effect. Reframe every decision on your own terms. Status quo bias. Schedule a quarterly financial audit. Recency bias. Zoom out to a 20-year chart before any decision. The Harvard-linked research is clear. Awareness of a bias is the first and most powerful step toward neutralizing it. You now have awareness of 10. The traps are the same as they were an hour ago. But you're not. If this video gave you something real, share it with one person whose financial decisions you've watched a bias destroy. Subscribe for research-backed content every week. And drop in the comments, which of these 10 traps do you think has cost you the most money so far? Be honest. That answer is where your financial education actually starts. I read every single comment. See you in the next one.